Hello guys, what is up? New video. Today I spoke with a CFP or CFA about the investment options of investing with Cardone Capital versus mutual funds. And he kind of gave me some good pointers on kind of how the investment would work. And I also asked him some challenging questions about what if a recession hits, and he kind of gave me some answers. So that's all going to be in this video today, so let's get into it. To start off, Cardone Capital, as you can see, has a $5,000 minimum investment balance, which means that in order to start investing with them, you have to put in $5,000. So for a teen, that's quite a bit of money, and especially if you're going to college or if you're trying to save up for something, a car, or if you have a job and you're working, that's a lot of money. That's not easy to get. So that's a lot off the top. And then for mutual funds, you can get in the game with Ally for really whatever you put in, you can start investing. There's no minimum with Ally Bank. So that's a pro slightly towards mutual funds compared to Cardone Capital. And moving down, Cardone Capital has a 6% target rate, as you can call it. And that's basically the target rate that they try to hit is 6%. Whereas with mutual funds, you can find a bunch of them for 12%, and it's not that hard. Moving on, from that, Cardone Capital is a lot more risky because it's not diverse. And yes, if a recession were to happen, yes, you can say that people are going to end up selling their homes and going to renting. But if you look at the stuff Cardone Capital is investing in, they're not investing in something that if you just sold your home in a recession, you're going to flock to. They're all high-end luxury apartment complexes. So it's a lot riskier having all that money as a teenager in that bracket. Now I say that as a teenager because if you were older, had a better job, better paying job, better like financial stable wise, I think that would fit way better compared to being a teen, and I think that would just be super risky. Whereas the mutual funds, they would be diverse. So what that means is you would, if something went down, you wouldn't lose everything. It would be diversified to where you could not lose all your stuff in one go. And if a recession were to happen, in the 2008 recession, the mutual funds were back up in a year, whereas real estate, it's still, it took longer than a year, way longer than a year, because people were still going bankrupt and selling their homes well after the recession as well, and couldn't really hitch onto that climb. And the bigger guys in the locations or wherever you want to call it, they were still buying the houses for cheap. And moving down to the next one, for the Cardone Capital, for you to get your money back completely, to get your $5,000 with a 6% targeted ROI, which means it could be lower, could be higher, it would take you about 12 years to do that. Whereas with a mutual fund with a 12% that you can find pretty easily, it would only take you 6 years. So by getting in now and starting investing now, it would make a huge difference compared to waiting, saving up, putting all your eggs in one basket, and potentially having the risk of losing it all. So going down to the very bottom, we have the Cardone Capital set. It would be $25 monthly. It pays you out monthly, which is pretty nice, and that is a monthly dividend. Whereas with the mutual funds, it can range, it could be less, it can be more, and it's also quarterly. So when I spoke to the CFP or CFA, he basically told me to go with the mutual funds, and then once I have a bigger investment portfolio where I have the capital to do that, and I don't have my whole investment won't be just in Cardone Capital, that's when you invest in something like that to take the risk away. Anyways, I hope you guys enjoy this video. Make sure to like, comment, and subscribe, and I'll see you guys in the next one.